Bob Gelfond is the Chief Executive and Chairman of MQS Asset Management. He's the former Director of International Trading at D.E. Shaw & Company. Bob Gelfond, good to have you with us on Bloomberg.
Thanks for having me.
All right, so beyond the obvious headline of stocks falling 2% today, is there a specific reason that you can point to that says, all right, this is why people hit the sell button?
I don't think there's ever a specific reason. Clearly, the market has become more worried in the last few weeks about growth slowing, not just in the U.S., but in Asia, which has been really the engine of growth for the world economy over the last couple of years. I think there's some concern about perhaps liquidity getting tighter in the U.S. with QE2 ending. I think that's probably misguided, but it's still a concern for some people in the markets.
Why do you think it's misguided? Is it possible that maybe not, we don't get a QE3, maybe we get a Queen Mary, maybe we get something else, a Hail Mary pass?
I don't think that QE3 is necessarily in the offing, but I think people are somewhat overestimating the impact that QE2 had, because a lot of the cash that the Fed was putting out when they were buying these bonds actually ended up back at the Fed in terms of reserves held by excess reserves that the banks are putting on deposit at the Fed. Additionally, as long as the Fed keeps interest rates very low, and particularly with the news the last few weeks, there's no indication that that's going to change. Monetary policy is going to be easy, but monetary policy only can do so much for the economy. There's certainly a lot of other factors that have to be considered with fiscal policy and regulatory policy and whatnot.
Well, since the announcement by Federal Reserve Chairman Ben Bernanke about QE2, the S&P 500 is up about 25%, notwithstanding today's 2% decline. So are people getting too panicky about equities? Because if you talk about interest rates, they remain low. We saw the 10-year go under 3%. Wouldn't that be good for stocks?
Well, I think it's true it's good for stocks, but this real story is the dollar. The dollar weakened all through that period, and then you saw the last few weeks as stocks have gone down, this dollar has strengthened. So really the overriding story, and this is true with commodities too, is how strong the dollar is or how weak the dollar is going to be. When liquidity is out there and there aren't really concerns about growth, the dollar sinks versus stocks, which means stocks go up, commodities go up, other currencies appreciate against the dollar. But when everything reverses, people start to get scared about growth. It's the exact opposite thing happens, and that's what we've seen the last couple of weeks.
So people putting money into the U.S. dollar once again.
Because they're concerned, they're looking
because
for...
it's not because they're happy, but because they're worried.
They're worried about risk, and they're looking at ways to reduce risk, which means taking off their commodity plays, taking off their stock plays, and means rushing back into the dollar and rushing into bonds, which looks like a safe bet if you're worried about growth.
So what would be a good trade at this point? I mean, if the dollar continues to strengthen, doesn't that mean, at least in nominal terms, that, for example, commodity prices, they'll go down?
It's possible. I think the way to play it and the way our approach is really to have lots of relative value plays on. So you're not trying to predict whether the dollar is going to continue going down, continue going up, or whether it's going to weaken again. And so that means that if you're going to be long some currencies against the dollars, also be short some currencies. Be long some commodities, but be short some commodities. Long stocks, short stocks, and really try to have a truly well-diversified portfolio of positions, and not just have one overriding bet. A lot of people think that they have diversification, but they really may only have one position on, but spread out in 5 different ways or expressed in 5 different ways. Do
you find that that's almost a danger for the retail investor, because they read about the star managers who make these incredible, one-position bets? They're either bullish on gold or they're bullish on the euro, and they think that they can replicate that. You're saying don't even try it in a way.
Yeah, exactly. There's a lot more risk out there, even when the market is maybe not moving up and down every day. The economic situation that we're in, unfortunately, is still very frail, and we could see more major moves. Maybe not to the extent we saw in 2008, but certainly there's a lot of risk out there, even though you may not see it. You saw it today, but you may not see it every day. So really worry about safety and not necessarily looking to hit a home run. If you just hit some singles to keep the baseball analogy, you can sleep a little better at night and survive through whatever turmoil might come out.
Last question for you, Bob. What about institutional investors? They feel the same way, do you think?
I don't know if they feel the same way. I think they should, the strategy should be the same for them as well. It's very easy to get caught up in thinking you have a diversified portfolio, and then you see the correlation spikes to 1 when things get really volatile, and that's what you really need to avoid.
All right, I want to thank you very much. Bob Gelfond joining us, Chairman, Chief Executive of MQS Asset Management.